Hello, I'm Graeme Bibby, Chief Investment Officer, joined today by Gerald, Senior Investment Analyst. We're going to go through some of the outlook for the economies, what's happening in markets, and therefore the implications for our portfolio positioning. First up on the economies. So we are seeing a better world for inflation coming down, GDP at a low ebb but starting to come up, employment looking better, and the policy response from central banks more supportive with cuts coming ahead. Through all of that in detail, we have seen the US peak in inflation before Australia, some 3 to 6 months, and Australia's quite some months behind that. So we would expect a policy response by the central bank sometime after that. GDP is looking more positive because we're seeing some leading indicators, particularly the purchasing manager indexes for manufacturing and services starting to recover. And that has implications also for a supportive employment market where we've seen some normalisation of wage pressures there and some of the capacity come back into the labour market. So when we look at equity markets recently, what have been our observations, Gerald?
Sure. Australian reporting season was quite mixed. We saw domestic cyclicals perform really strongly, led by retailers, which posted better than feared results. Growth stocks also did really well, led by the tech names, and they've rallied by catching the AI hype wave that's coming out of the US. On the other hand, resources as a sector saw the most negative EPS surprises, and that was driven by cost-driven earnings misses. In aggregate, consensus forecasts for financial year 24 and financial year 25 were flat over reporting season, and this suggests that the rally we've seen in Australian stocks has been led by valuations rather than earnings. Quickly touching on the most recent US reporting season, that was a lot stronger. There was great breadth to the results with 10 out of 11 sectors outperforming. The level of percentage of earnings beats and positive earnings revisions was in line with historical trends, and we've seen a really strong start to the year for the S&P 500 with the index up 10% over the first 3 months, and that's really reflecting a more constructive economic outlook in the US. How about fixed income, Graeme?
Well, in fixed income we look at two parts of the market. One is the cash end and the other is the long bond end or 10-year bonds. At the cash end, we're seeing more likelihood of those rate cuts being priced in, even though the number of cuts may be down from what was first thought, as a recession's being less of a chance, more just a normalisation of financial conditions and real interest rates. So we see those cuts coming, but in the 10-year bonds, the converse is happening. So we're seeing that yields there are holding up, mainly because that recession scenario is off the table and we are extending when those first cuts may happen. So that's why we're seeing quite a divergence there. And in credit within fixed income, we're seeing that as being very well supported, similar to equities where it's more risk on and risk-taking environment. What does that mean for our positioning and asset allocation technicals?
Yeah, sure. So we're seeing momentum is still very strong in the market. On sentiment, it is bullish across both retail and institutional investors, but we think there's further to run for institutional investors, which have repositioned their portfolios from underweight equities to now slightly overweight equities. Valuations are starting to look stretched when you look at the MSCI World Index versus historical norms. However, that's largely driven by the US. Ex-US valuations are in their normal range. And we also think there's scope for earnings to grow in the US based on a more constructive economic environment. What does that mean for our positioning, Graeme?
Well, what it means is that our outlook is still relatively positive, given the evolution of the economic data and what markets are pricing in. And it means that we've moved from a underweight late last year to adding back to that position to neutral. Now we're slightly overweight. We're quite happy with that position and would only change that if the environment changed materially. So we're looking at scenarios and the risk to that central case, and the risks would be, for the downside would be a recession coming earlier, or some other shock. It could be a geopolitical shock or other. That means that we would need to adjust our positions and that those probabilities rise. We might even see a positive case where we could even lean further into equities if there's more positive things to come, or we just allow our asset allocation to move there of its own accord. So overall, we're seeing a optimistic environment overall, the beginnings of the next business cycle, and we're positioned for it, but we're conscious of the risks and we'll be risk managing our allocations.
Thanks.
Okay.